Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to continue on with part 2 of a OneNote practice problem related to a consolidation where we have a parent-subsidiary relationship, the parent having a controlling interest over 51% of the subsidiary, but not 100%. Therefore, we do have a non-controlling interest we'll have to deal with. We also have the focus of the problem being on the parent purchases the subsidiary bonds from a third party, and this happened in the year of consolidation. So in other words, S issued bonds to a third party. The parent purchased S's bonds not from S, but from a third party. That then happened in the current year, the year of the consolidation that we will be doing at this point. Now, this is the second presentation with regards to this practice problem, so you're going to want to go back to the first presentation if you have not seen that thus far. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're on the 838 tab. So if you have the tab, you can go into that. If not, that's okay. We're going to go on down to the point we left off last time. So I'm going to scroll on down to that point. We're going to be all the way down here. We're going to be starting basically our journal entries. So here we are, and we're on the first journal entry. So it's going to look like this little colorful entry down here. And then I'm going to put the reveal tab on it, so that we can do this step by step as we go. Prior to this, we've been working through some tables and doing some of the calculations with tables that will help support the calculations we will now do now, or the journal entries that we will now be putting together with the consolidation entry worksheet. So now we're on the consolidation entry worksheet. We've got the parent company. We have the subsidiary company. We're going to be doing our standard process, that being to total them up, of course. That's going to be our starting point. Then we're going to be doing our elimination or consolidation entries. That will be in this column. This column will include all of the entries that have been done up until the point, and including the current journal entry we are working on to give us our ending consolidated trial balance. So now we're going to do our normal kind of beginning entry, which is basically eliminating the equity section and showing P's basically reflection of the investment in S. So I'm going to start off with the investment in S. That needs to go to 0. So the investment in S up top is going to go to 0. That's going to be this number. We're looking at the stocks at this point in time. I'm not going to put the amount in it yet. We'll get back to the amount, but I'm just going to start there. And then the next thing we're going to deal with is the equity section for S. So this is S's equity section, standard practice. We're just going to basically eliminate the equity section. So here's the 4AT4. We're going to debit it to make it go away. So here's P's common stock. Here's S's common stock, total common stock. We then are posting this debit, which will then be removing or decreasing the common stock, bringing us back in essence to P's common stock. Same process we're going to be doing with the premium on common stock. We have the 264,000 credit. We're going to debit it to make it go away. So P's, S, total. We removed S back to basically P's number. Then we're going to go on down to do the same thing to the retained earnings. It's on the books at a credit of 454. Therefore, we're going to do the opposite thing to it, a debit to remove it. So if we post it, there's P, there's S, there's the total. We removed it back to P's number. Next, we're going to go to the dividends. Same process. It's on the books, however, with a debit as opposed to a credit. Therefore, we'll do the opposite thing to it, this time being a credit to remove it. There's P's, there's S, there's the total, there's us removing S. Here is us back at P. Okay, then we're going to say here's the income from S. That's the next thing we typically look into. The normal calculation for that, if we pull out the trusty calculator went to the wrong screen. I'm pulling it into the proper screen. Normally it would be the net income down here, which would be the revenue minus the expenses. So that would be the 153,000 times the controlling interest percent, which is 90%. So I'm going to say times the 0.9, which would normally be the 137,700, but we're going to change that with our table. So we made this table before. This is going to be an adjustment to our entry. So this 137,700 is now changed in accordance with this table to the 155,790. So there it is there. The other side will, of course, be on this transaction, so it'll be okay. We'll be able to even this out. Then we're going to have the non-controlling interest in net income. That's going to be normally calculated as the 153,000, taking that net income times the non-controlling interest, 0.1, which would be that 15,300 here, but we're changing it according to the table to 17,310. So there's the 17,310. Then we're going to have the non-controlling interest in the net assets NA, which would normally be assets minus liabilities or equity section, calculated as 37,000 plus 86,100 plus 363,900 plus 200,000 plus 517,000 plus 188,500 minus 615,000 minus 169,000 minus 100,000 minus 3,000. So normally we'd take that 1,302,000, which we can also find on our table down here, 1,302,000, and we would multiply it times the non-controlling percent or 10%. We can also get to that 1,302,000 by adding up the equity section for S. Let's do that real quick. It'll be less numbers this time. Won't be quite so bad. 484,000 plus 264,000 plus 454,000 minus the dividends, 53,000. Then I'm going to just add the net income at the bottom line here, the 153,000. So we'll say plus the 153,000. And that's going to be that same 1,302,000. So that 1,302,000. Also note one other time is that this middle, that 1,302,000, normally we would take that and multiply it times the 0.1, and that would be the 130,200. So now there's the 130,200. We're changing it to the 132,210 according to our table. So there it is there. And then this number up top, we're going to go back to it, would typically be the 130,200 times the controlling interest times the 0.9, right? That's our amount on the table here, but we're changing it to this number. So this is the number that we're changing it to, and so that's going to be this number up top. So in essence, these kind of middle numbers, if we were to add up the middle numbers, have now changed to our adjusted equity. So notice we had the beginning equity that we adjusted to basically this number, the 13221, which of course is kind of like the middle numbers now, the 84, that's wrong way, 484,000 plus the 264,000 plus the 454,000 plus the 155,790 plus the 17310 minus 53,000. Now we're at the 1,322,100, which is going to be this number that we're now breaking out and in terms of the controlling, non-controlling interest, the 9010. So that's going to be our transaction. It's going to be balancing out. If we post this up into the investment area, investment in stock, still not down to zero as we expect it to be at the end of the day, but we will get there hopefully. And then the non-controlling or the investment from S is posted here. Again, we're not to zero yet, but that's okay. Then we have the non-controlling interest down below 17,310 and the non-controlling interest in NA in this item on our posted to our trial balance here. Next. So this is what we've done thus far, and this is going to be the current journal entry we are working on. These are going to be posted to this column, so it's going to be including the prior journal entries up to the point in time and including the current journal entry we are working on. We're now going to be thinking about the goodwill. So we calculated the goodwill, and then there was an impairment on it. So we can do this in like a two-step process, putting the goodwill on the books and then the impairment. Or we can kind of net them together, which is what we're going to basically do here. So we're going to basically net these together. Now this impairment that happened in the current year. So we have this impairment that's happening in the current year. So if you imagine what would be the process, you could say, well, normally you'd put the goodwill on the books, which I believe was the 50,000, and then we'd have to reduce it by the impairment, which would be, crediting goodwill, decreasing it. The other side would have to go somewhere. It would go to an income statement account, which is part of our problem here because now it's hitting the income statement for the amount of the impairment, in this case, the 25,000. So we're going to break this out in two components. We're going to put the goodwill on the books later at basically the net amount, the amount minus the decrease. And then we're going to think about kind of like the incomes, the impairment side of things, this being the expense side of things that we're going to apply out to the controlling and non-controlling interest. So the impairment then is down here. This is the loss, which again, you could think of the goodwill going on the books and then going back down We've got the impairment loss of that 25,000, which we're going to be breaking out between the controlling, non-controlling interest on the income statement, that being the income from S, and the non-controlling interest in net income. So that's going to be the 25,000 times the 0.9 is the 22.5, and then that 25,000 times 0.1 is going to be that 2,500. Posting this out then, here's the impairment on the goodwill. That's going to be down here. There it is posted there. The other side going to the income from S. It's going to be included in this number. That then takes us down to 0, which is nice. And then we've got the non-controlling interest in S down below. That's to be included in this number. Next transaction. So note once again that these ones up top have been posted. This is what we have done thus far. Here's the goodwill impairment loss transaction we just did. Those are already included now up to that point, and including this point in time in the consolidation column. Now we're going to think about the balance sheet side of things, putting the goodwill on the books in terms of the balance sheet side of things. So on the balance sheet, we could have said goodwill goes on the books with what it was on originally for, calculated to be 50,000 here, and then record the impairment, decreasing it by the 25. Instead, we're just going to basically put it on the books at the net amount. So now we're thinking about the balance sheet, just the balance sheet side. We're going to put it on the books at the net amount, which is the 25, which is the 50,000 minus the impairment we saw, which brings it down to the 25. So then we're also going to think about the land, because you'll note that we had this land here that was part of the initial difference from the book and fair value at the point in time that the original purchase took place. That's going to be something we're going to have to add to the books as well. So we're going to be adding it to the land side of things. That happened a while ago, no effect on the income statement. Then that's going to be part of the differential. So then we're going to say, all right, now we're just going to apply that out based on our percentages, 90-10, controlling, non-controlling, to the balance sheet side of things. That being the investment in stock. So it's going to go up in the investment in stock here, and the non-controlling interest in A. So we're simply going to add these up, the 25 and the 30, break them out 90-10. So the 30,000 plus the 25,000 is the 55,000 times 0.9. That's going to be the 49,000 going to the controlling interest, balance sheet side of things, investment in S stock. Then the 25,000 plus the 30,000, 28,000 times the 0.1, 2,000. Oh, something happened there. 25,000 plus the 30,000 is the 55 times 0.1. There's the 5,500. It's going to the non-controlling interest in net assets. So if we see that this goodwill then is included up here, goodwill is now on the books. Land has now been increased by that 30,000, which is the original differential at the point in time the stocks were purchased. And then the investment in stock down here is going to be increasing. That's going to be the investment in stock up top. What am I here? We're not at 0 yet, but we're getting there. Then we have the non-controlling interest balance sheet side. Here it is. All right, next item. So these transactions, this is what we have thus far, including what we did just last time. It and what we're going to do, the current journal entry is now included in this this consolidation column in our transaction. So now we're going to be thinking about those intercompany transfers of inventory. To do that, if we look at the first half of basically the table that we used to help us with the first journal entry, and we adjusted that first journal entry with these two top line items, which were adjustments for the inventory items, inventory prior year reversal, inventory current year deferral. These two items are going to be needed as well. So I like to think of them just like in a standard kind of process that I'm going to have to go back and adjust with those two involved, and some other adjustments that'll help us get the cost of goods sold correct and the inventory correct. So first we're going to be thinking about that 5,100. That's going to be also needed to be part of the change to the cost of goods sold. It's going to be a credit to cost of goods sold. Then the other side is going to be going to the balance sheet side of things for the controlling, non-controlling interest, that being controlling interest, investment in S stock, non-controlling interest in the NA. So we're going to take that 5,100. We're going to be multiplying that times the 0.9. That's going to be the 4,590. And then if we take that 5,1 and multiply it times 0.1, we get the 510. So then the cost of goods sold here is included in the cost of goods sold here. The investment in S, that's up here on the balance sheet, investment in S, bringing us back down to 0. That's what we want to see. That's good news. Non-controlling interest in A is going to be included here, included in that number. Next item. Now, before we move on to the next one, just note that this 3,000, it'll be included like I promised to, but we're going to do that basically at the end. So I kind of split these up so they're not right next to each other. Like it might, so in any case, just note we will be going back to another transaction related to these inventory things. It'll be the last one, and it's going to be including that 3,000. Okay, so this is what we have thus far. In the new this is one we just did. These included the new transactions. There's going to be 3 of them. So, and they're going to be included in this column. So now we're going to be considering the bonds. So what do we got to do with the bonds in terms of the consolidation? We're going to be considering this bond first, which is a bit more of a simple bond transaction that was intercompany that happened. Because on this one, we had P issued the bonds to S directly. So we don't have this third-party business, and it was issued at par. So we don't have a premium or discount we have to deal with. That means that on P's books and S's books, you would expect to see a nice kind of mirroring transaction between these transactions. Now, we did have one bit of complication in that the interest is paid on March 31st and September 30th. That means that we do have an accrual type entry that would be involved here. And that accrual entry we figured out, I won't calculate it again, but we figured out when we calculated these items. These items are what we put on the books earlier. We didn't put them on the books. We recalculated what would have done for P and S with regards to these bonds in the current time period. And part of what would have happened for P and S is they would have recorded the interest payable, reversing the prior year accrual here, and the cash, and then the reversal of that on the other side. And then in the current time period, they would have recorded the transactions. Basically, I'm netting, the transactions together to record what would happen for the year here, which would be 20,000 of the interest on the expense side of things, and then they've got their accrual of the payable, and then the cash here. So the cash for that time period netting out to the 20 total between the two. In any case, that mirrors nicely over here with what we said happened on S's side of things, which is interest income of the 20, interest receivable, and cash. So we've got a nice mirroring transaction. It won't be the case. That won't be as nice when we go to the other bond, which was purchased from a third party, and that complicates things. But in this method, since this works nicely, it's nice to break this out into a couple different components, including, let's take a look at, for example, just the balance sheet side of things first. So we're going to say, well, the bonds, we have a bonds payable on the books. So the bonds payable is on the books right there. Bonds payable is on the books right here on P's books. It needs to go off the books. So we're going to do the opposite thing to it because it's all intercompany or going from P and S, parent subsidiary related. So we're going to debit that by the 200,000. Then the investment in P bonds. So we have the investment in P bonds up top. It's on the books at a debit of the 200,000, equal and opposite. So of course we will simply remove that as well. So those two are going to go away. Then we've got the interest income and expense. Those two are going to be overstated. And again, because they purchased, they issued directly to each other, they will be equal and opposite. In practice, we could probably find those by looking through the detail for the general ledger for the interest income and expense accounts. In a book problem, we would probably have to recalculate them as we did down here. So we've got the interest expense and the interest income both being overstated, so we will simply reverse them. Interest income typically having a credit balance, we're going to debit it to make it go away. The interest expense having a debit balance, we will credit it to make it go away, posting it out. We're going to record the interest income in other income up top, so it's included here. And then the other expenses, interest expense being included in that row, so that's going to be included here. Then we had that accrual taking place, and that means that we had, as we can see down here, the payable and the receivable on the books that we're going to have to reverse off the books as well. So if I go back over and say, all right, we had a payable on the books, 5,000. We're going to have to reduce it. We'll reduce the payable by debiting it. So we're going to debit the payable. Then we're going to reduce the receivable by crediting it. So here's the receivable. We will reduce it with a credit. And that would be similar to any kind of other, mirroring transaction for a receivable and a payable intercompany that we would have to then remove. Next transaction. Here is what we have done so far, including the last 3 transactions, and this is the current transactions up until and through the current transactions. Those will be included in this consolidation column. We're now going to be looking at the other bond transaction. It's a bit more complex transaction because this one had purchased from that third party. So this is the one where we had P purchased all of S outstanding bonds from an unrelated company. So P issued them, S issued them, and then P purchased them from a third party at a later point in time. So face amount 1 million, and then the years are going to be 10. The rate was 12%, and they purchased at 98. That's what P purchased them at, but they were originally issued at the 101. Originally issued at a premium. The interest is on December and January. In essence, it's the interest is as of the end of the year, so we don't have that accrual kind of issue. All right, so we know if we think about this, we're going to say, all right, well, we know that the whole bond is going to be intercompany. So here on S's books, the issuer, they have the bond payable on the books at the 1 million. That's got to go because that's total. The whole thing is intercompany. So we're going to be debiting the bonds payable by that 1 million. That's going to be one component. We also know that if the entire bond is going, then the entire premium is going. So that's straightforward as well. We're going to say the 3,000, the entire premium that's currently on the books related to these intercompany bonds needs to be removed. It's on the books as a credit. We're going to do the opposite thing to it, debiting it to make it go down. Then we also know that on the other side of things, on the investment side of things, P over here has the investment in the bonds on the books at the 985,000. And that's good that you notice that one's going to be going up as the life of the bond goes to the face amount of the 1 million, and then the premium is going to be going down. So this number needs to go off the books, that 985. But notice those two don't mirror, the difference between those two don't mirror each other because P purchased them from a third party. That's why we result in some more kind of confusion here. So the interest income has to be going off the books as well. We calculated the interest income below by thinking about what the journal and which entries would be, at least from a consolidated total for the entire year transactions would be. And we have here that we've got the cash, 120, the investment in S bonds, and then the interest income at the 125,000. So we have the 125 on the interest income. However, on the interest expense side of things, because this is going to be S's side down here, this is P, this is S. On S's side of things, they're reducing the premium for the 1,000. So this was part of the difference that's a result of that third-party purchase transaction. P purchasing it at a discount, S purchasing it or issuing the original bonds at a premium. So that means that the interest income is going to be going down by the 125. So in other words, included in income in here, it's going to be other income, which will include the interest income. We had the intercompany income of the 125 that has to be removed and decreased and therefore debited. And then on the interest expense side of things, we're picking up the 119, which can be found here. That's going to be in the interest expense or other expenses here that, once again, it's on the books as a debit this time. So we're going to have to remove it with a credit. Then we also have the gain of the 24,000, that being calculated here. That was the gain on the constructive retirement of S, which happened basically in the current year. So we've got the full 24,000. That's going to be that difference that's going to be reported in the gain here that we are also going to have to remove. So that's going to be the full transaction there. Let's go ahead. And before we go through it, just note that you might want to spend some time with this journal entry and then some time with this gain calculation to just mull over how it is that that this gain is basically the difference between the difference in the interest payments and the bond premium and the bond payable amounts due to that kind of third-party transaction. So you might want to spend some time just mulling over this transaction and then these journal entries and see how they all fit together with basically the reversal process and why we need this gain and what this gain is going to be doing in terms of how it's going to look basically going forward in future years. So in any case, if we post that out, then of course the bonds payable up top, the bonds payable will be going off the books. So we're going to be removing it. It's included in this number. The premium on the bonds payable, that $3,000 is going to be going away. The investment in the bonds is going to be up top. We have the investment in the bonds. It needs to be going away. It's included in that number. Then we have the interest income. So that's included in other income. So that then is included here, and decreasing the interest income. The other expenses, including interest expense, is included in other expenses. That's going to be going here, decreasing the expense. And then the gain we're putting on the books at that $24,000. Next transaction, I'm going to pull this thing on down so we can have it down there. So next transaction, we may not need it. This is what we've done thus far. So we've entered all these. Here's the last one we just did, and this is the current one we will be working on. All of these, including the current one, is included in the posting of this column in the consolidation worksheet. All right, so now we've got this item where it says, as of December 31st, 2000X7, S declared but not yet paid dividends of $13,250. So dividends have been declared, but they have not yet been paid. That's going to result in a receivable and a payable for the intercompany dividends that, dividends receivable and dividends payable that we're going to have to reverse out in a similar way as if we had accounts receivable and accounts payable. That would be for the $13,250 times the parent's portion, or 90% of it. So we would expect to find in the receivable and payables $11,925 on our books here. And if you take a look here, we're going to say that's going to be then in, we just put them in the receivables and payables. So they would be included in all the receivables and the payables. Okay, so the payables are overstated by that $11,925. So we're going to do the opposite thing to it, or debit it to make them go down. The receivables are overstated by the $11,925. They're on the books at a debit. We're going to do the opposite thing, or credit them to make them go down. Payables then here are going to be included in this number, and then the receivables are going to be included up top in this number. So that's pretty straightforward. Reversing entry working very similarly to accounts receivable and accounts payable reversing entry. Then we're going to go down to our last transaction here, and we're going back to the inventory. So I promised we'd go back to that inventory transaction. So this is what we have thus far on the left-hand side, including the last one we just did. Those are all included, including the current one in the consolidation column. So now we're on the current one. This having to do with the inventory, and you'll recall a while ago, we included this 5,100 in the inventory. This is our consolidation. This is our worksheet that we use to help us with the first journal entry. And we also used it to help us with one of our inventory adjustment journal entries, adjusting the cost of goods sold and then now the revenue related to it. So now we're going to do the other adjustment because our revenue is overstated for these intercompany transactions. I'm pulling that information, the revenue, from the current period transactions where we recorded what happened on the inventory. So I pulled the relevant portion here, which is the current year upstream transaction where we had sales of the 81,000. That sales number needs to be reversed because it was an intercompany sales. Revenue has a credit balance, so we're going to do the opposite thing to it, or debiting it to make it go away. Then we're going to have the inventory, and that's where this number is going to come into play. This 3,000 is going to be a credit, so I'm going to pull it from this table, and I think it's useful to kind of have a routine of doing that because then you're kind of using both of these numbers. So we're going to credit inventory for that 3,000, and then the difference is going to go to the cost of goods sold at the 78,000, the 81,000 minus the 3,000. All right, so then if we post that out, the revenue, 81,000, is going to be reducing the revenue here, so that's included in that number. The inventory up top is going to be included here, so we have the adjustment to the inventory, and then the cost of goods sold is going to be included there. So that is going to be it. You want to check through it and see, okay, we've got the investment account in stock as well as the investment in bonds that are intercompany, and the investment in P bonds, intercompany bonds, have all been taken down to zero. We see this number, which is, of course, the income from S. That should then be taken down to zero as well. And, of course, the equity accounts here for P are now basically reflected because we removed them for S. So the equity accounts basically reflect what is seen on P's books, which is the typical case. So those are just a couple numbers that you can kind of look into and double check on.